Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Tuesday, April 5th, 2022. And our top story today, Secure 2.0 passes the House of Representatives. What's next? Well, joining me now to discuss this and a lot more, David Levine and Kevin Walsh are both principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, thanks so much for joining us on the program again this morning.
Jeff, it's great to be here as always, and thank you for the time.
Absolutely. And Kevin, let me come to you because we actually spoke a little bit about this on the podcast on Sunday. Big news. Secure 2.0 passes the House of Representatives almost unanimously. Give us your reaction, your take on this.
So, Jeff, it's really exciting that Secure 2.0 passed the House last week. It passed with broad bipartisan support. I believe it was 414 to 4 in favor of passing the legislation. What's nice about this is that we talked in 2017, 18, and 19 about how rare it is for retirement legislation to have real momentum. And looking at Secure 2.0, it seems that there's a fair amount of momentum. And, having gotten through one chamber, if it can get through the Senate as well, there's a real chance it can become law later this year.
Well, that's a good sign. We'll talk about passage in a little bit. David, I want to come to you because one of the key provisions, we're going to go through about 3 or 4 of them, the expansion of automatic enrollment. That's a big deal. It's almost compulsory here.
You're absolutely right, Jeff. It basically is, with some carve-outs here and there, designed to basically say, in order to be a valid 401k, in other words, in English, qualified, so meet the IRS rules, you will have to put in, for like new plans, automatic enrollment. So people have to be automatically enrolled at potentially 3% or more, and it's designed to facilitate savings. I will say I think that is a big change, but if you look at the vast majority of large plans and increasingly a lot of smaller plans and especially pooled employer plans and MEPs, you see a lot of people already doing automatic enrollment. So I think it will help move the dial in some ways on newer plans, but I think in a lot of ways, it's going to sort of affirm the steps that many plan sponsors have already taken to try to get their folks into plans. So I think that's kind of the key takeaway on this at this point.
Yeah, and we go back to the PPA. There have been major steps. We look at Secure about expansion. We always talk about expansion of workplace savings. Kevin, I want to come to you because one of the other key features here is an increase in the RMD age. That's the required minimum distribution. That's the date that you were required to begin taking distributions. This is pretty significant. It used to be 70 and a half. It's been expanded.
And this is a really significant change. When we look at the retirement system, there's a real focus on reducing the risk that individuals run out of money. And there's really 2 ways that we can reduce the risk of running out of money. One would be to have higher account balances, which I think we all support. The other is to shorten the period of time where people are required to take distributions or take distributions from their retirement accounts. And in some ways, it signals that folks are working longer. But, prior to Secure 1.0, the age that people took distributions were required to start taking distributions was 70 and a half. Now it's been moved up to 72. And what Secure 2.0 would do is it would allow retirement savers to, essentially keep their money inside their plan longer. And, this isn't an immediate jump, but over the next 10 years after passage, it would essentially raise the RMD age from 72 to 75, which, on the one hand, it means there's fewer years that they'll be taking money out. And then on the other side, it provides for more years of compounding for retirement savers to have a higher account balance.
Yeah, there are a lot of people out there who dread the 70 and a half RMD for a lot of reasons. We're not going to get into them here. There's also the cost factor, which we'll circle back to in a couple of minutes. David, let's come back to the age 50 catch-up. I lived through EGTRA, the Economic Growth Tax Reconciliation and Relief Act of 2001, passed by President Bush, signed into law, that established age 50 catch-up. Now we get more enhancements.
Absolutely, Jeff. And it's really interesting. And I think it's good to keep in mind because you get lots of studies out there. For instance, DCREC has its like 22 DCRC defined contribution study. And when you look at these studies, catch-up contributions are very widely used, and they're adopted very broadly and across many plans. There's very few I know of that don't have them at this point. But at this point, catch-up contributions, there would be some changes. First of all, a key one is that catch-up contributions, you'd have an extra bumped up limit for people who are nearing like that age 65 in those last couple of years to be able to put extra money away to basically enhance their savings, a little goosing at the end, which especially if we have a down market at some point and it's before retirement, it's a way to help people to try to recover as best as possible. Similarly, because of the funding pieces in this, which you alluded to already, Jeff, there are changes about things like catch-ups being made into after-tax Roth-style contributions, and that's another piece that we're going to see as we go forward. Because in the world where we have run up a lot of debt, these bills try to pay for themselves as best as possible. So those are two things to keep in mind. But if for retirement savers, as Kevin said, I think it will be a great opportunity to increase savings. And also, one other note, for IRAs, it will actually index the catch-up limits there as well. So it's enhancing the catch-up rules and taking them to a new step so that retirement savers of all types, whether in a 401k or an IRA, get enhanced savings.
Yeah. Kevin, I want to come back to you. Last provision, and I had to leave this one for you, my friend, because it's looking what I would call missing participants. And I know this is a passion of yours, establishing a way for people to find lost assets, 401k assets, pension assets, et cetera.
And there's been a lot of talk about how the federal government can help in solving the missing participant problem that American workers and American companies face. Because really our retirement system is only as good as it is at connecting individuals with the benefits that are promised or the benefits that are due. If those benefits don't arrive, then what are we all doing here? But at bottom, what this does is it creates an avenue where the federal government can have essentially a lost and found, where participants can provide updated information, where the government can help those participants connect with their plans that they may have a benefit from. And then, at bottom, connect everybody, plan, participant with their benefit. And hopefully what this does is it signals a bit of a pivot from a world where we're hoping that participants contact their former employers to update their addresses to one where, employers and participants are able to go to a central one-stop shop and connect each other with benefits or with benefit requests.
Yeah, really important. Get those email updates. Get those address updates. Got to make sure you have that if you move from job to job. A lot of people are moving along. All right, I got about 30 seconds before we have to go to commercial break. This is going to be a summer of fun because now past the House, but we're not done yet, gentlemen. Do each of you, David, let's start with you, want to weigh in on passage? Are we going to see passage? Here it is, April 5th, Tuesday, April 5th. What are the chances?
I think it's a pretty high probability, definitely in lawyer speak, more likely than not. There are some differences of things people in the Senate would like to see added to the bill. In addition, there are things that, tweaks, clarifications. So it's not going to be immediate. It could either be June, July, or it might even wait till after the election. That's my take. All
right, Kev, your thoughts?
I think David just summed it up really well. If it's going to pass, and I think the Senate will do their own thing, and then they'll combine it with the House bill and smush it together. But if it's going to get done this year, it's all in all likelihood, in my view, it'll get done by the end of June, or it'll get done sometime around the holidays in December.
Yeah, well, fingers crossed. Gentlemen, before we go to a quick break, I just want to make a mention. Today's show is powered by the Defined Contribution Real Estate Council, DCRC. Gents, they've got a new survey coming out for DC plan sponsors to respond. It's on investment management, record keeping, and et cetera. Any thoughts there?
I think it's a great thing. The more research we have in the industry about different structures and understanding what people are doing, whether it's fees or even beyond, and just features, parts of their plans, it's a really great idea. So Jeff, the more research, the better.
Yeah, and I'm sorry to interrupt you, David. And people who want to complete the survey should go out to the website. It's probably right below. And Kevin, they've got a thought leadership series coming up as well, so people can check it out. They can subscribe and participate.
They do. April 28th in Chicago is the next event in the series.
Yeah, Chi-Town. You don't want to miss that. Well, gentlemen, like I said, I've got to take a very quick break. When we come back, The Department of Labor has proposed new regulations. We'll break it down and a lot more. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. We're talking this morning to David Levine, Kevin Walsh. Both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, thanks so much for staying with us this morning.
Jim, we're glad to still be with you.
Yeah, it's great to have you. And I should add, referring back to this survey, it's also done in partnership. This DCRC survey is done in partnership with NAREM and Ferguson Partners. Don't want to leave those folks out, of course. All right, David, I want to come to you.
No worries.
You guys are not interchangeable, and we love you. Let's talk about some new and proposed regulations that if someone's sitting out there in a retirement committee, they're a consultant advisor, they're counsel, they are a fiduciary. What should they be aware of in terms of new guidance, new proposed guidance?
Sure. And I think I'll hit just a couple quick items here because I know there's some more topics that Kevin will definitely want to hit. I think right now, if you're a fiduciary, you oftentimes are seeing, and under the Biden administration, the administration is putting out a lot of guidance. There's a lot of things coming out. So sometimes it is what is proposed and what is final. I thought what I might focus on a little bit is just what is final very quickly. For instance, there's new rules about advice on rollovers out of your plan. Some plan fiduciaries don't have a strong view about money staying in or out, but some want it to stay. As a result, your vendors, whether it is your record keeper, your TPA, your advisor, your consultant, may be coming to you at this point and saying, I need to get certain disclosures, certain approvals, or they may be going to your participants. A takeaway for you right now is, what role does rollovers play for you in your business or in your plan, and really evaluating, does this guidance impact me? How do I comply? Or what does it mean to how I run my plan? Two other things that are out there that I'll mention very quickly. It's been out for a little while, but I know Kevin hit this on the prior segment with the lost and found. Clearly, we still have the Department of Labor out there doing missing participant focused activity. And we still have as Kevin and I always like to talk about, the soft guidance or the website postings about how you deal with missing participants. Similarly, you've also had recently from the DOL in the last year things on, for instance, cybersecurity and standards and processes. And if you're a fiduciary, this has been around for a while. Kevin and I have been very engaged in this for different organizations, but cybersecurity is something that it's important whether you are an advisor, a consultant, or a record keeper about what do you do there, or if you're a plan fiduciary, what are the rules and how do you deal with your vendors, and also what happens if there is a breach. There's a lot we could talk about, but those are some key things that folks should be aware of at this point. But I don't want to burn our entire segment, so back to you, Jeff.
Thank you. And Kevin, I mean, there's a lot there, and you and other counsel have to help break this down and steer the client along with the consultant and the other people around the room. Let's talk a little bit about litigation. You and David have both talked to us on the program about the evolution of litigation. It's not just about fees anymore, Kevin. It's about data. It's about a lot of things. Did you do a record keeper search? How did you arrive at that decision? So there's an evolution here.
And Jeff, you're hitting the nail right on the head here. And I think David and I have a very catchy phrase when we talk about what a plan sponsor or plan fiduciary can do to avoid litigation. And it's typically process. We're looking at the case law that's out there. We're looking in particular, most recently it was a Northwestern decision at the Supreme Court. And really those cases and recent case law drives home that when a plan fiduciary is making a decision, they're going to be facing a lot of competing factors. It's great that courts are recognizing there's competing factors. And what this tends to mean is that, if you're making an investment decision, you want to, document and think through what those factors are. If you want to have a process for decision making, one thing that many plans have is they have an investment policy statement, just a way that they can help document that, even if we have a great process for this one investment, we also have a consistent framework that we can use as appropriate in evaluating investments. And beyond that, you're hitting on another factor here, which is the outside of just fees. And it's that, the plaintiff's bar is getting creative. And when we look at the services that plans get, record keeping, for instance, in order to find participants, you've got to share things like participants' names and addresses. And, when the plaintiff's bar is looking at some of this, they look at information being shared with service providers, and they're beginning to assert that, there's something nefarious going on. I think one of the challenges we face is how do we get more Americans to a secure retirement and connect them with their benefits? And information is really important for that, but it is heating up as an area of interest.
Yeah. I like that you mentioned the 3 Ps: process. David, let's kind of wrap things up with you. You actually talked a little bit about this with website postings. One website posting was around cryptocurrency. That's a key area for our friends in the Department of Labor and other enforcement agencies, but also ESG and sustainability, I think, as you said at the top of the segment, both really important initiatives for this Department of Labor.
Absolutely. And let me try to hit this very quickly. The Department of Labor recently did a website posting. And I know on the podcast, Kevin and I have gotten into much greater detail with you, Jeff, about how a rule becomes a law, kind of that old TV series you watched on Saturday morning as a kid, possibly. But the key is the Department of Labor put a posting up, which is they spontaneously said that talked about cryptocurrency and basically says that from their perspective, they have concerns about crypto and they are going to investigate plans that use cryptocurrency in them. It's really remarkable because if you change the blanks a little bit and you just change what's written there, you could do it for emerging markets or other features of a plan. And there is concern in the industry, regardless of whether or not you are a crypto fan, that this type of guidance, and guidance I put in quote, sort of opens the door to swings in interpretation. We thought we saw a lot on environmental, social, and governance types of items, where from the Clinton administration all the way through the Biden administration, we've had yo-yo back and forth. And the Biden administration now is focused on its ESG guidance, which is designed to allow ESG to be used inside defined contribution plans, a change from the Trump administration as a valid concern. Those types of discussions are things that plan sponsors need to watch, and they have to watch out for the whipsaw, because this is something that's out there at this point. I know we're running long on our segment, so I think the simple answer is these are things to watch, and let's see how it evolves.
Yeah, certainly. I feel like I'm watching a tennis match, back and forth, ping pong, or a ping pong match. Well, gentlemen, I want to thank you so much for joining us, and I also want to remind the audience, don't forget the 2022 DC Survey. You can find that on the Defined Contribution Real Estate Council website, and also the Thought Leadership Series, which begins on April 28th. David Levine, Kevin Walsh, great to see you. Thanks so much for joining us, and thanks for sharing your perspective.
Yeah, better data builds better results, so participating in that survey is really helpful.
Thank you.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content? Search our archives. We'll check out our website and our streaming partners like Amazon, Roku, Samsung, over 100 more. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.